All right, everybody. On today's episode, Paul and I are giving a replay of the live Wealth Warehouse webinar we did in March 2025. We talked about a few different things, but the main conversation was around policy loans and the differences between those and bank loans. So, what'd you think of the call today, Paul?
Yeah, it was great, and I think it's always a question that comes up. People are interested in the mechanics of policy loans. And then once they realize how awesome they are, they'll realize, like us, that it is simply the best borrowing position one could ever find in the financial world.
Yep. If there was a better one, we'd be using it. All right, everybody, enjoy. Hey, I'm Dave.
And I'm Paul.
And this is the Wealth Warehouse Podcast.
We wanted to talk about policy loans, since that is sort of a central tool to practicing the infinite banking concept, right? Everyone always wants to know, how much cash am I going to have available? When is it going to be available? All the questions that you guys probably had during your process and will continue to have as you open up more policies. And so we figured it was a good thing to talk about as kind of a central theme of IBC.
Yeah, and I'd like to know actually for the couple of you guys who were meeting for the first time, do you have a policy or no? Like if you don't have a policy, okay, gotcha. So Tom, no.
Two. I've got two.
Okay, great. And
we got two whole life policies. One is IBC structured, one is not.
Okay, cool. And Nathan says no. So okay, good. So we'll this conversation will make it understandable for everybody. But that's probably one of the biggest things people want to learn more about before they even get a policy in force is how's this whole loan work and why is it beneficial to me to take a loan from an insurance company versus a bank or versus paying cash. So if everybody's read Nelson's book, Becoming Your Own Banker, that's going to be a great start. And we can go from there, but we'll just dive right in to policy loans. Paul calls this really an unseen advantage. So, I mean, you and I were talking about this before we hit record, like having access to these loans, what has that done for you?
Well, you said this, but policy loans make life easier, right? And that's, more broadly, access to cash makes life easier. We were talking before we recorded, and a guy that we know in the real estate business was saying, I don't keep any cash. Cash is trash, whatever. And puts all of his money in deals minus his reserve, which he does keep in whole life insurance policies. Or I should say more accurately, it's not in whole life insurance policies. It's with the life insurance company, and the policy has contractual value. That's probably a more accurate thing to say. But anyway, so what I have found in my personal life and my financial life is that I like having contractual access to a large pool of cash, in this case in the form of whole life insurance policy loans, which I get to guaranteed with no application, no questions asked. They don't ask what it's for. We all have been through a loan process with a commercial bank, right? We have bought cars. We've spent hours at car dealerships doing financing or going through the different financing options with one of the managers or whatever. We have all likely purchased homes. Those of us in the military have purchased multiple homes in our careers. And the mortgage process seems to get more and more involved every time you do it. People who have been listening to the podcast for a while know that I'm building a home. I've got some clients that are building homes. In banks, we always say this, right? Banks take collateral. Well, when you're building something, there is no collateral because there's nothing that exists yet, right? So it's a higher risk and therefore a more involved underwriting process. So the time that you spend sending documents, all these things, right? It all goes back to it's It's just awful. And wouldn't it be great if we could control the banking function in our life? And again, ultimately, that's what we're trying to do here.
Yeah. And it doesn't mean we can't take loans from a bank. You just have more options now. There's just more flexibility in life when you have access to capital through your life insurance contract. What's funny is what you just said, being at the dealer and doing auto financing and stuff. It reminded me, I think it was Roto who told us this, our good friend. He was at a dealership and he was going to buy a car with cash because he had his access to capital in his life insurance policy, and he, requested a loan, had that money sitting in the bank, ready to pay cash for a car, and then they presented financing options to him, and the financing guy said, "Well, if you finance this, we can give you $1,000 off the sticker price," and I think he even said, well, what if that was like at 5%. He's like, well, what if I finance it at 8%? Do I get more off the sticker price? And I think he got more off the sticker price. He's like, yeah, we'll give you $1,500 off the sticker price. He's like, all right, let's do it. And then he confirmed that there's no prepay or early payment penalty,
Right.
like early payoff penalty. So he did the financing, got $1,500 off the car, and then the next day went in and paid the loan off with cash. So he saved $1,500. So, and you could say, well, you could do that if you just had money sitting in a checking account anyway, right? Sure, you could, but you're probably not thinking like that. Do you think those people who preach pay everything in cash are thinking, maybe I can use financing to my financial advantage? They're not, because they're not thinking like bankers.
Yeah, I think for some of the new folks, and this is a learning process. I think everyone on here that's either a client of Dave's or mine or a shared client or neither, but can shake their head in the north-south and say that they've changed the way that they think, right? Or they have rethought their thinking. One of Nelson's 5, principles is rethink your thinking. And everyone here I'm sure, is thinking about the way they look at the financial landscape completely different than they did prior to practicing the infinite banking concept, right? It changes the way you think about money and how to go about do things. I don't know if we want to, Dave, for the new folks, we've got a little definition of what is a policy loan. That might be constructive just to kind of lay it out.
Yeah, let's talk about, so there's not a misconception out there on what exactly is cash value. What are you borrowing and what are you borrowing against? Yeah, I think that'd be great. Go ahead.
Yeah. So before you define what a policy loan is, you have to kind of understand what cash value is, right? Everyone, when our grandparents got, when Social Security came out, right? They all thought they had like their own little, safety deposit box that the government was, putting money into. Like my grandparents literally believed that, right? Maybe they were just, ignorant, but I think a lot of people in that generation, that's literally what they were thought. Maybe they were told that by somebody, but, your life insurance contracts, your policies, don't have some like little account where your cash value is sitting in building value, right? It doesn't. When you hand premium over to the life insurance company or repay loans, that cash is now property of the life insurance company, right? Through your life insurance policy, though, you have the contractual right. Nelson talks about this in the book, right? You are first in line because money can and must be lent so that the life insurance company can meet its future obligations down the road, the death benefit obligation. So you have access to that pool of capital, right, that the life insurance company has, and they issue that capital to you. For IBC, the way we practice it, we use the policy loan feature. We don't take withdrawals. We don't do surrenders. You can do those things. We do not do those things. We use the policy loan feature, as Nelson taught us to do. So that's a simple way to kind of think about what cash value is, right? So what is a policy loan then? Okay, well, I'm going to read a definition that I think is good, and I pulled it from a book that I'm reading, And it's from a fellow IBC practitioner that we all think very highly of, but here it goes. It's a policy loan is a credit instrument issued by a life insurance company collateralized by a policy with sufficient net cash value. It's the mechanism by which a policy owner may exercise accumulated purchasing power, this is important, this last part, without liquidating assets. And I think that those last three words, without liquidating assets, is really powerful. Wouldn't you say, Dave? Addressing opportunity cost.
Yeah, and you can do that with other instruments.
Sure.
Like, real estate. You can leverage real estate and get to the equity and use it as collateral. So, get money from a bank, collateralizing that asset without liquidating it. You can do that with stocks if you have certain stocks and you have enough of them. Like we always use the example, Jeff Bezos doesn't have to liquidate Amazon stock to go buy his next mansion. He just gets a loan against that stock because that's capital, that's value. It has economic value that can be traded, and so he doesn't have to liquidate it. The difference is with the life insurance, it's very simple and easy, and contractually you're right to do so based on how much value you have in that asset, meaning the cash value. Well, I'm gonna put you on mute there, Tom. Oh, okay. So you have contractual right to that access, which is the equity that you own of that asset in the death benefit, right? The death benefit being the asset, however much equity you own, you have access to it. And then two, this is an asset that a loan, and I'm trying to think of any other type of loan like this. The loan is guaranteed by the lender. Usually you have to bring something to the table that guarantees a loan for the lender so that they'll lend you money. In this case, the life insurance company has created their own guarantee in that life insurance contract that they're willing to loan against. Like that's why they're so confident in loaning that money to you and why you don't have to repay it on any certain schedule whatsoever, because they've already guaranteed that loan is not going to default. It's impossible to default.
Yeah.
I
don't know if it happens anywhere
loan.
else. Where a company guarantees the underlying collateral, the lender is guaranteeing the underlying collateral, which in this case is the death benefit. I'm fairly certain that doesn't really happen anywhere else in the financial space.
Definitely not in the mainstream financial space that many of us are aware of. So, pretty cool to think about that. It's actually the death benefit that is guaranteeing everything. So, for those of you who don't have a policy yet, the reason that that policy actually guarantees the loan is going to be repaid someday is because you're guaranteed to die someday, which means the company is contractually obligated to pay out a death benefit to your beneficiary.
Yeah, so
they can just recoup the outstanding loan balance at that time and then pay the remainder out to your beneficiary.
Yeah, so another way to think about it is it's fairly simple, right? When you get a policy loan against your contract, against the policy, really all the life insurance company is doing is fronting you the future cash flow. The death benefit is a future cash flow, right? They're just fronting you some of that, the equity you happen to have. So let's say you've got $1 million death benefit, maybe you've got $150,000 of cash value, which is the present value of the death benefit. At age 121 in the United States, age 100 in Canada, the death benefit and the cash value are the same number. I got in an argument on YouTube with somebody several months ago who's an IUL guy, maybe it was a Dave Ramsey guy. Probably a Dave Ramsey guy, I think.
Well, either way, with IUL, nobody makes it to age 100 anyway with those things.
No, they don't.
Yeah.
And he was like, prove that the cash value is mathematically the present value of the death benefit. And I said exactly what I just told you guys. And he's like, that doesn't make any sense. I was like, so people think that they're an unbundled thing. Like the cash value is just some sort of like savings account tied to it's not.
There's no money just sitting in the cash value account.
It's not.
It's a ledger entry, period.
It's a ledger that's all it is. That's
Yeah.
right. So hopefully that makes sense.
Yeah. I like what you said, that the cash value alone is basically just giving you your death benefit today. Hey, if you don't pay it back, then, then your family's not going to get it later. But if you do pay it back, then they will get it. You either take it now yourself or you pay it back and it goes to your family later.
Yeah, that's
And
right.
either
You're
way,
either
it's
gonna-
going back into your family economy.
That's right.
one way or
You're either going
another.
to pay the interest on the loan, you're going to pay off the loan, or you're going to die. Those are
Yeah.
the three options. Or you're going to get the
wonder-
loan so big.
So are you saying that in Canada at age 100, the
Policies
policy,
they endow.
it
Yeah.
endows
It
and
used
they
to be.
cancel the policy and write you a check for the death benefit?
I'm assuming that's what happens. I don't know their laws in particular, but in the United States, my original whole life policy is endowed at 100.
Huh. I thought maybe it's because in Canada they euthanize old people. Maybe you're not allowed to live past 100.
They are doing that.
Yeah.
Like you can do it voluntarily now. You can just go in there and be like, it's crazy. Have you guys heard that? Anyway, that's totally off topic, but it is true.
We tend to get off topic sometimes.
It's true.
Yeah.
They are doing that. It's crazy.
But
anyway,
yeah,
Okay,
I'm go ahead.
I was going to say, hopefully that all makes sense. We try to keep things simple here at the Wealth Warehouse podcast. There's a lot of noise out there depending on who you're listening to, what you're listening to. So we like, our content to be accurate. So, yeah.
Yeah, so we've got a whole list of reasons why policy loans are the best loan you could ever take, the best loan terms you could ever have. But I'm interested to hear anybody who's taken a loan, or even if you haven't, you have a policy in force, you probably know some of these things. So, like Wes, why would you rather take a loan from a policy than from a bank? What's in it for you?
It's cash value. Let's make easy numbers.
Oh, we can't hear you, man. It's like, where's your? It's all muffled. I'm sure it was a brilliant answer, though.
Brilliant. Maybe you could type it into the window, Wes, and I'll read it for you.
Yeah, but
Who else?
yeah, I know Will has policies. So, Will, why would you want to take a policy loan instead of a bank loan?
Control, and then not contributing to inflation. Two big reasons. You can skip payments. Like if you end up in hard times, emergency or opportunity comes up, maybe you don't want to make that auto payment because you need to pay for plane ticket to go see your grandma before she dies or something. Take the family on that trip. You can skip the car payment, go on the trip, and then make the car payments when you get back. If it's a bank loan, you're going to have somebody knocking on the door saying, hey, where's our money? And you go too many months, they're going to take the car back, and now you're in worse financial position.
Yeah, they don't care that grandma's on life support. They want their money.
Yeah, and for new people too, that's a huge theme of practicing the infinite banking concept is that idea of controlling the function of banking. I think Will, that was spot on. For us, Dave and I talk about control all the time. I think it's the most important thing that we talk about, that we love about living this lifestyle, the IBC lifestyle, because it's a lifestyle. It's a way of living, in a better way for sure.
Yeah, it's not a noun; it's a verb. I bet David Waller has some thoughts too. Why would you ever want to take a policy loan instead of a bank loan?
Yeah. So for us, when we found out about IBC, we were looking at, I think, over $20,000 or so on credit cards because we funded some business expenses and stuff on that, and we started paying interest on some of those credit cards. So we started to play the game of rolling over credit cards and doing balance transfers and applying for new cards and all that stuff just to avoid the interest. So as I learned about infinite banking, I was like, well, we could just pay these cards off, but then that money's gone. And yeah, there's more room on a credit card, but there are certain things you can't get involved with a credit card, like investing in private deal or, sending money to someone. They're not going to accept a credit card. Right. So what we did was started a policy, funded it, and just kept paying the minimums on the credit cards. And then we used the cash value to turn around and pay off a bunch of credit card debt in almost one fell swoop. So,
Yeah. So you started prioritizing your own capital instead of the credit card company's capital.
right.
Yeah. Or instead of the mortgage lender's capital, or the car payment. Like all these people paying extra on their car payments, they're paying extra on their mortgages, and that's fine. You are saving interest. That's a fact. That's true. Mm-hmm. But you're also giving up something that you also need to consider, right? That's the opportunity cost that Nelson wants us to think about. You have to consider the alternative use of money. There's always trade-offs.
Yep. And being on somebody else's payment schedule. So I forget how many credit cards we had, but it says you have to pay this certain amount at this time, and it's on a month. So our monthly cash flow is getting crushed.
Yeah.
Because it was going all to these mandatory things. Well, when I'm in full control of when and how it gets paid back, then that right there was probably when I started sleeping at night again. Just when all that money went to the policy, no one called me saying, hey, you haven't made a payment in a couple months or whatever. And then we were even able to use some of that capital to invest with an opportunity that came up. And so we had that available to us. And we said, hey, well, we could pay off more of this or send in our cash, or, since it's a time-based investment, then let's just send it in now. And then we dictate the payment schedule as we come into more cash flow.
That's good. It kind of flies in the face of that, that verse in Proverbs, I think, the borrower is slave to the lender. You're actually not the slave to the lender in this scenario, because you make the rules. You control the terms of the repayment to the life insurance company. They don't need to get that money back on any certain schedule, because like we already said, they've already guaranteed that you won't default on that payment.
That's right.
Pretty
all
cool.
Baked into the design. Tom typed a question in. Okay, so it's multi-part question here. So how does policy loan repayment plus interest fit into the policy structure without MEC reached? So MEC, modified endowment contract. Okay.
I
So
think
policy
we
loan.
know what you're getting at. Yeah.
Yeah. So, well, do you know what he's getting at? Because I was going to say
Yeah.
there. Go ahead.
What I think you're getting at, and tell me if I'm wrong, Tom, is in the book it talks about paying that interest back to yourself. So if you can actually pay more to yourself, aren't you actually overfunding your policy beyond what that maximum premium is, which would MEC the policy in many situations? And no, that's not actually what you're doing. When you pay that interest, quote, back to yourself, what you're doing is you're prioritizing your own capital. Again, you're paying that loan off quicker. Now, every different insurance companies may accept loan repayments in a different manner. The one we primarily work with, every loan repayment you make is going directly to the principal, not the interest. So you're knocking down the principal. So if you calculate, hey, I'm going to pay 5% to a bank, I might as well pay 10% to my own bank, and you make your payments at 10% interest versus 5%, you're just going to pay off your principal that much quicker.
Right.
You can't actually add more premium to your policy than what's been illustrated and is in the contract when it's issued. You just pay it off quicker. And then ideally you get to that point where that extra payment, hey, I can make this extra payment. Well, you pay the policy loan back and you still have cash. Well, you want to put it somewhere. That's when you expand your system, the natural expansion of your system. Start another policy to start putting more money into that one. So yeah, you can't improve the performance of your policy by taking loans, because you can't put more money into it than what is already calculated for your premium.
Right.
So you won't MEC it. Don't worry about that. They're not going to accept that as extra premium.
Correct. Yeah, you won't make the policy. You know, Nelson in the book talks about additional interest, and then there's an addendum, I don't know, on page 58 maybe. I don't have my book.
Is
in
it
front of me.
58? I was looking for because there's a footnote.
Yeah, go to
Yeah,
page
you're right.
50.
You're right. It's a footnote. You're right. It's 58. So a lot of people skip over this footnote because we don't think footnotes are important. But
How
in
many
this
people
book,
knew it was page 58?
they are? I did not. Good job, Paul. 58 and 48. 48 is one I quote quite a bit. But that footnote says actually this quote interest is not really interest. It's additional premium that has been paid into the policy that equals the interest that was being paid to a finance company. That is the reason that it is adding to the cost basis of the policy. If you have trouble understanding this, go back to the grocery store. So he does make it sound like it's extra premium, which is it's not quite accurate. I think I knew what he was saying, but it's not. You can't add extra premium to a policy that's already been put in force.
I think what he's assuming in some of those examples in the book is that the trucker or the equipment finance, whoever it was had loans out, was able to service the base premium, which is required premium every year, and he wasn't able to pay his full or some of his PUA premium, which is optional, which is can be unscheduled premium, and that's how we prefer it. And that once his loans were paid off, he took the extra cash flow or the cash flow that he already had and just redirected it. Now it was going back to servicing a policy loan. Now that policy loan has been serviced. Now it goes back to pay his maybe catch up paid up
PUA.
additions or his full PUA space that he has in the policy. And that's how you add value to a policy. It's only two things you can do to the company, right? You can send them premium, whether it's base, PUA premium, doesn't matter. Premium is the only thing that adds value to a policy. And then, of course, non-guaranteed dividends, which you could kind of think of as a form of premium that's given to you for free. It's not out of pocket, I guess, is a more accurate way to say that. That also adds value to the policy, increases, PUA premium buys, let's say $1 for dollar of death benefit. So if you're paying a $20,000 PUA, maybe buys $20,000 of death benefit, increases the cash value accordingly, and it's bought and paid for. There's no future cash flow required for it, which is why the cash value goes up that quickly when you pay PUA. Anyway,
Yeah, you're either going to pay premium or you're going to repay loans.
That's it.
Yeah,
That's right. Okay, another good question here. Let's see. This is from Nathan. So the PUA does not need to be paid at the time of the policy initiation, or can. So it depends. Can we design initial premium that features base, of course, and PUA premium, and the PUA be unscheduled? Yes, we can. There's, with the companies we use, we can kind of do all of the above. We can schedule it, have it unscheduled.
I would say that's the exception.
Yeah.
Because my question back to you would be, why would you create a policy designed that you can't fund the full PUA right now anyway?
Yeah.
We want to create these so you maximize that premium, even though you have flexibility and you don't have to pay all the PUA. But typically we'll design
That should be
policies
the
that
exception.
in year one that you need to fund the entire thing, the PUA and the base. Starting year two, you don't have to fund the PUA, or you don't
should.
have to fund it on a schedule. You could fund it anytime, any amount throughout the year.
Yep. And we've had clients. There's a client on here that has a large unscheduled PUA every year, and that's how just timing wise, that's how we had to make it, and that's okay. But it's fairly rare. Dave and I are of the same mindset. We generally design policies that people can fully fund every year, base and PUA. And frankly, you should prioritize base and PUA. You have to prioritize the base, obviously, but your PUA, I would prioritize your PUA over loans generally as well.
Yeah, but I think that option that you're talking about, that unscheduled PUA, may be a good option for somebody who has regular bonuses, like a large annual bonus coming in at a certain time of year. And you never know exactly what that bonus is necessarily. So you don't want to be kind of held to it, but you want to be able to fund that if you get that bonus, that amount. So it's all completely tailored to your specific situation. So everyone is different. I hope that answered the question there, Nathan. Good. Nathan asks, I thought that was the delta between an amortized loan schedule and the average value interest calculation, and that difference was the additional money towards PUA.
That might be nerding out too much. It might be that. I don't remember specifically. It could be either, though, if that makes sense, Dave.
Yeah, I wouldn't overthink it. It sounds, and maybe he's just offering an explanation.
Yeah.
And maybe that's the case. I tend to keep things pretty simple. Paul was in the Army, so I have to talk real simple, use small words, and talk slowly around him. Only because, Paul's not actually a really smart guy, believe it or not, if you guys didn't know that.
High cholesterol.
He's got, and he brags about high cholesterol, which is actually good for you. Right, Waller?
Gary Brecka says it is, so.
Your brain needs it.
Yeah.
It's your immune system.
Your immune system needs it?
I'm never sick. Anyway.
Yeah.
All right, so cool. Good. Those are all good questions, good commentary.
Yeah, here's some other reasons I like policy loans. One of the biggest is that I can take a loan. I don't have to liquidate the asset, and the asset continues to grow even while I'm, using it. So that cash value, depending on what company you go with, and even non-direct or even direct recognition companies, I don't really want to get into that discussion or debate, but I prefer non-direct recognition companies, same as Paul, that don't recognize any loans out that you have when it comes time to pay the dividend. So your cash value, your equity in that contract, in that policy, is going to get the full dividend payment, whether you're leveraging that and collateralizing that for a loan from the insurance company or not. So every year I could have maybe $100,000 in cash value. I take $80,000 out as a loan to go pursue some opportunity. I don't make any payments back. I'm still getting the dividend on the full $100,000.
Right.
Now, that is pretty powerful right there. You don't have to liquidate the asset. You still get to let it compound uninterrupted while you utilize it at the same time.
Correct.
Let's see. What are some, here's one I really, really like. Privacy. Privacy. Do any of these policy loans show up on a credit report? Do they show up on your debt to income ratio when you go work with a bank? Nope. No, it's off the books, more or less. So you don't have to, I get this question a lot, even from people who have policies. Hey, what do I need? It's tax season. This is my first year one of a policy. I've taken some loans. What do I need to give my CPA?
Very common question. Nothing.
Yeah. I say, I don't know. What do you need to give your CPA about your medical history? Nothing. Like right. This is private.
It's privatized banking.
Yeah. So private from anybody and everybody, and protection. So I've got a story about, I had a client here in Minnesota, which is one of the least protected states in the union when it comes to your cash value. Like in most states, it has very good cash value protection. The official limit is very low in Minnesota. However, in real life, I had a client who went through a pretty brutal examination with a 3-letter agency, and they examined everything, and he basically had to liquidate all of his assets and send it to Uncle Sam. And the only thing that was not touched was his cash value. And he had more than what I've seen as the limit of being protected. They didn't touch it, period. So he told me, and he still talks about it today, he's like, this is the best asset I've ever had, because if it wasn't for that, my wife and I would be on the street. but that cash value was retained. He's in like year 5 of his policy. It's going great. And yeah, no kidding. That was the only asset they didn't touch. I thought that was pretty awesome.
Yeah. How about this one? We talk about, kind of the freedom to do what we want. That's part of this lifestyle, right? You can use policy loans for any purpose. You can't go into a bank and say, give me some money. They're going to ask why, right?
They're going to ask why, even if you want cash from your own account. They're going to ask what it's for.
It's awful. I had a really bad, not a bad experience, but an experience with Navy Federal the other day. I made a large repayment on one of my HELOCs, and they didn't apply it. They're like, yeah, we put that into a holding account. So I'm on the customer service. I'm shredding this poor person. Like, I'm so mad. I'm like, well, I'm eating, because I didn't notice. I'm like, why isn't this applying? And it should be paid off. I was like, did I eat, 10 days of interest on that balance? They're like, yeah. I'm like, I'm not paying that. And anyway, it got working. I won. I was like, what are you doing? Anyway, so what do you think about the mortgage process? When you're in the underwriting process for a mortgage, and I talk about this all the time, they're like, don't move money, right? That's what your loan officer's telling you. Within a few weeks or a few months of whatever, try not to move any funds, right? Because guess what? Dodd-Frank or whatever law back in whatever requires them to disclose and show every single transaction, and they have to ask, and it's super annoying, right? When you log into your online portal or however your life insurance company does it and you request a policy loan, there isn't any of that, right? And that is worth a tremendous amount of time. Right, and we all value our time, right? It's a very limited resource that we have, and you can get to your capital to do what you got to do without question right now, and then in a couple of days, the money gets direct deposited into your account of your choice. I don't know what you can't. I can't illustrate that. I can't place a dollar figure on it, but that is worth a lot.
Yep. Yeah. Another thing that's worth a lot, there's an actual value to having cash, to just having cash available. There's a lot of value emotionally, and for things like building a house or, just having those cash reserves. But it also gives you so many more options. Like just last week, Paul and I were at the Infinite Banking Concepts Practitioner Think Tank, which is an annual meeting of all IBC practitioners, any of them who can show up. We spent a couple days at a conference, guys up on the stage talking, learning, networking with other practitioners and learning from each other, learning different strategies and whatnot. But I was thinking about it, and I had, in all transparency, I had a car loan on my wife's car. I had the cash in my cash value to pay for it, but I decided to get a car loan because I wanted to keep that cash available. Wanted to keep my powder dry, as they say. Well, a year and a half later into that loan, I'm thinking, okay, I've got enough powder dry right now that it just makes sense for me to stop sending interest to somebody else's bank and pay off this car loan and start sending that interest back to my own bank. So I did that. We were sitting out by the pool, like making phone calls and stuff in the afternoon in Orlando, and I talked about it with Paul for like 30 seconds. I said, I'm just going to do that. So I got on there and then paid off the car. Because I had the cash to do it. And I decided that's more valuable at this point, saving that interest, going to somebody else's bank, than it is to have that capital available for the next opportunity that comes up. So I'm the banker. I can make that decision. I can do whatever I want. So my priorities can shift from having capital available for opportunities to, hey, let's just pay off some debt, increase my monthly cash flow. I'll be able to repay that quicker. So just more options.
Yeah, that's what I was thinking, Dave, is there's really no, I've got a couple car payments, and I definitely have the cash value where I could trade them out. But again, that's not the right time for me right now. If you listen to one of our recent episodes, I talked about my friends that were building a house and they bought the land with cash and they paid off their house. So they have $1 million of equity that the bank doesn't care about.
They don't care.
They could have had $1 million of life insurance cash value or damn close to it. So it's just, remember, think of those things. Just rethink the way you think if you're not already thinking like that. It is quite the switch for a lot of people to, well, I gotta get out of debt. I gotta pay this off. Well, if you have the ability to pay something off, what's the difference? I'm earning money over here in my life insurance contracts.
I know.
And yeah. So, I don't care. I'm earning, the value is increasing every year, every day in my life insurance policies. I'll pay the bank interest until it makes more sense for me, timing wise, to trade out those debts with policy loans. But that's okay.
Which is why I definitely don't agree with that phrase "cash is trash." Like, it should always be invested. It should always be earning for you. Not all equity is created equal. You think that $100,000 you sent to a syndication deal, an apartment deal, has any value whatsoever to a bank that you're trying to get a construction loan on? They could care less. They consider that not coming back to you. They didn't underwrite that deal. They don't know if that money's coming back to you. Maybe they think you're a stupid investor and you made a bad decision, and so are the syndicators. That's just completely off the books. It doesn't matter. Not all equity is created equal. Your friends who had $1 million of equity in a home, banks don't care just about the asset or the collateral that equity is in. They also care about how long is it going to take them to get to that cash. How long does it take to liquidate that? $1 million home is going to take a lot longer to liquidate than the cash value sitting in a whole life insurance policy.
Yep. Yeah, tough lesson. And hopefully they don't repeat it 10 years from now and they build another house.
Yeah. If you would have bought all your cars for cash, great. You don't have.
I'd have no money.
You don't have any debt, but you also have no cash, and the bank wouldn't be working with you to build a house.
Nope. I tell you guys, it saved my butt practicing this. Luckily that I've been practicing this for a long time. I've owned whole life insurance for 20, what year is it? Yeah, so 23 years. I've owned whole life insurance. I've owned dividend paying whole life insurance since 2019, and I own a lot of it, and I pay a lot of premium. That's just like in Nelson's book. He needed to up his premiums, right? When he got hit with the baseball bat across the face. Same thing. It really saved me, and we're able to kind of realize our dream earlier than we would have. Maybe by 15 years or so. So it's quite a bit, quite a good news story for us.
Yeah, premium is the solution.
Yep, problems aren't going away.
Nope. So what else? Any other big things you like loans? You like to use those loans for?
Yeah, I mean, I think everyone's said, we get predictable, you get good terms. I always say this is there isn't better leverage available.
Yeah, go into a bank and say, I'd like a loan for $50,000. You can charge me 7% interest, but I want to pay. I'm not going to put up any collateral for it. Like, I'm not going to put my car or my house up for it. I'm going to decide when I pay you back and how much I pay you back, and I may not pay you back at all. Is that okay? What do you think is going to happen?
Yeah, you get laughed out of there. Yeah, it just doesn't exist. So it's a great place to be. But that, obviously I guess all of this, which is say you're still protecting your legacy because you're using whole life insurance, right? You have an increasing pool of capital that grows every single day contractually. You get non-guaranteed but very reliable dividend growth on the policy, so you never stop earning. Your money's uninterrupted compound growth over a long duration, right? And it creates a very powerful financial tool, not only for us but our children if we have them, and that future, people that don't exist yet, generation 3, generation 4. Nelson talks about, I don't know the page number off the top of my head, but the even distribution of age classes when he's talking about trees. Same thing, affecting people that don't exist yet. very important.
Yeah. So Tom asked, he threw a question in, wouldn't the first lien, basically the first position, the first position HELOC, is that what you're talking about, Tom? Like on a mortgage? With dollars available, be that powder dry capital added to your policy, eliminate the need for your car loan altogether. And I didn't need a car loan. That's just it. I had the cash to pay for that car with a policy loan if I wanted to,
Right.
but I didn't want to because I wanted to keep powder dry.
Yeah.
If you got that first position HELOC, or principal only mortgage, or however, it's advertised, if that's what you're talking about, right? Like not having a mortgage, just having a HELOC, a home equity line of credit. I actually just talked to a local couple here about 2 weeks ago who did that exact thing. They jumped on that strategy and they paid off their house. They had 27 years left on it. They paid it off in 3 years using that first position HELOC. So now they have access to hundreds of thousands in a HELOC. And they can use that as dry capital, dry powder. But if they took some of that money out and put it to work, they're not earning on it anywhere else, right? They're earning on it in one place. So they might be a couple who are poised to actually use that money and I don't recommend this for like 99% of people, but if you know how to use that stuff smartly, that's available capital, and you can use that for anything you want. Could be policy premium for somebody who's smart and understands the risks involved in doing that. Yeah, that's dry capital. You could bank with that. I mean, that's kind of how they're taught to do that, is kind of bank with their home equity line of credit.
Right.
Put all their money in there,
Velocity
pay
banking.
their bills out of it. Yeah, it's velocity banking. I mean, the velocity part works. They pay it off quicker than they otherwise would have, but they're callable. Yeah, just like Will said, you don't control the terms of that loan. The bank does. And I think the fine print in all of those home equity lines of credit are going to say the bank can call that note due.
Sure. Yep. Yeah, and it's a one, like you said, you're not earning in a HELOC, right? It's just a thing that costs you money. I have two of them. They're great for what they are, but I kind of use them as my break glass, or if I have to transact something quickly, I do that. But then I'll just replenish the HELOC with a policy line. I literally just did that. I was in the same scenario when I bought the lot that we're building on. I could have paid for it in cash, but the future is unknown. I kept the powder as dry as I could for as long as possible.
And then when you're in a comfortable position, you can decide to chunk it down or pay it all off if you want.
Yeah, I tell you, that's one of the unseen things, Dave, is that, and we talk about it a lot on the podcast, guys, is, making decisions from a position of strength and comfort rather than, hat in hand with the banker, the loan officer. It's totally different. You sit back and kind of relax and really, really take some time to think about stuff. And like, you can pay it off. Just keep paying the bank. It's okay. Whatever. Right? It's really quite powerful. And getting back to the premium finance stuff, using HELOCs or whatever people are going to do what they're going to do, there's never a problem until there's a problem.
Right.
As James would say.
Yep. So here's a couple questions. We'll try to cut this off in about 5 minutes. So if you guys got questions, throw them in.
Yeah.
But Rick asked if you've determined the existing policy doesn't have flexibility to pay back more than your outstanding loan plus interest. Does the interest go to the insurance company's profit? Yeah. So anytime you take a policy loan, you're actually borrowing the insurance company's money, and they are going to charge you interest on it. You're an owner of the company. If you, as an owner of the company, would you ever want your company to loan money out at 0% interest? No. So they are going to charge interest. So once you pay your loan back, your principal is all paid back, then the interest you've accrued during that period of when the loan was out to when it's all paid back, then you can pay that interest off. That'll be calculated at that time.
Okay. That was the thought process that I had, and I figured that was it. And ultimately, I could care less because, it is going to affect dividends later on possibly, and you want the business to be profitable. So,
Right. And that money's coming back to you through dividends. Exactly like you said. You may have seen a rise in interest rates for those of you who have policies now in the last year or two. Their loan interest rate, which is still significantly below a standard commercial rate right now. Like, try to go get a personal loan at a bank, you're double digits still. Last time I checked. But the rates have risen, and it's good that they've risen, because what happens, I'll just give you guys a quick peek behind the curtain in that industry. When the loan interest rate is 5% and you can't get a loan out in the commercial world for less than like 11 or 12%, everybody rushes to their 5% policy loan. Well, that removes a lot of capital from the company that they can't be earning bigger returns elsewhere. Right? So now they're only earning 5% on that money when their other investments are making them double digits.
Right.
Which could affect the dividend. It will affect the dividend. So they need to make it a little more competitive to make people think just a little bit harder about just taking their policy loans versus finding financing in other ways so they can make more money for policyholders.
Yep. It protects the dividend. We told them to raise the rate in one particular company a while ago, and I thought they did it too late. But, they're slow moving machines, right? Mm-hmm. But if you look at Nelson's book written in 99, 2000, when it was published, those rates that they were illustrating in those policies were enjoying interest rates from the 1980s and 90s when rates were high.
Double digits. Yeah.
They were double digits. So, everyone's like, I want lower interest rates. I'm like, well, that's why you can't afford a house now, is because rates were too low for too long.
Exactly.
If you don't understand that, you need to read like some Henry Hazlitt or some of the other Austrian guys, Menger, or
we're probably right at about where mortgage rates should be, 6%.
My first rate in 2006, guys, was 6.375 30-year fixed, and it just was normal. The house was $159,000.
Right. It wasn't. Yeah.
That house, I looked it up the other day, is now 300 and whatever thousand.
Right.
So
Chris asks, do you have a rough estimate on how much convertible term costs compared to IBC whole life for the same amount of coverage? Obviously, term
it's not even comparable.
It's not a comparison. It's of course way lower.
Chris, if you want me to throw some quotes and numbers, just shoot me a note. I'll give you a quote for what you want.
Yeah, I mean it's pennies on the dollar.
But I've got like a 10-year term that's like, I just converted some of it, and I think the new, how much is it?
I'd say if you're a good health 40-ish year old male, it's going to cost somewhere around $1,000 per million.
Yeah,
annually.
That's probably good swag. Yeah.
That's a good swag if you're healthy and
Chris is very healthy.
Your mid 40s or under, it's gonna be somewhere around there.
Okay, thanks. Yeah, I'm looking for my wife, but because I don't have a policy for her yet.
Yeah, well, I mean, a convertible term is he noticed if you get a convertible term, you'll be set to go whenever you're ready to convert that to whole life, and you can pay that whole life premium.
Yep.
I would challenge you to do a 10-year term instead of a 20 or 30 to challenge yourself to make that sooner than later.
Yeah.
That's what I did myself. Yeah.
Yep.
Yeah. All right. Will, you said the historical average is that the loan interest rate you've seen is about
mortgage historical average is 7.
Mortgage. Okay.
Yeah.
Mortgage rate 7.3.
Yeah, I'd rather have a 10 or 12% mortgage and the house was, didn't triple in cost in the last 20 years.
Well, they say that the number now, the average age for a new home buyer getting their first home now is 38 years old.
I was going to say it's 40. Yeah.
It's 38. How ridiculous is that the average millennial can't afford a house until they're 38?
Yeah. It's very believable, especially around here. Or really
It's-
everywhere, I should say, just everywhere. Even
Yeah.
Birmingham, Alabama is expensive, I'm sure now.
It'll ruin the
Relative
middle
to
class.
what it was, right, Rick?
Well, hey, if you can't build value, your equity and your wealth in a house anymore, I got a great place you could start building equity and value.
Yeah. Home equity should reside in whole life insurance policies, my opinion.
Yeah. Yeah. I'd much rather brag about the equity I have in my life insurance policies than about my home. So, 'cause I can't do anything with the equity in my home. All right,
My
I
net
need a lot
worth,
of
though, is
permission.
so high because my house is paid off. Yeah. Okay.
Yeah.
Try spending it. Anyway, sorry. You guys know how we think, so.
Yeah. Yeah, you got a current rate at that. Yeah, you might as well keep that and just rent it out. Yeah. All right, man. We're at the hour mark. So, hey, I appreciate you guys tuning in. This is great. And the questions are awesome. We'll plan to do this again next month. And, invite somebody who maybe it's a lot easier to understand this concept than to explain it to somebody else. So let us do the explaining. That's what I always say. So feel free to invite anybody, send that registration link out to anybody you want. Happy to entertain any questions whatsoever. And you guys have our contact info, right? Those of you, if you found this link on the podcast, then yeah, you have our email. So feel free, set up time with me or Paul. Let's talk about where you're at and what you want to do. And we're happy to get you started or get your next policy going or whatever we can do to help you. All right. That's all I got. You got anything, Paul?
No, just our sign off. World famous.
All right. Well, hey, until next month, control your capital.
Or somebody else will.
Hey, thanks for listening, everybody. If you'd like to have a conversation with us to see how you can become your own banker, or if you have any questions or topics you'd like us to tackle in a future episode, please send us an email to davidandpaul@theibcguys.com.
And subscribe and leave us a review if you're on Apple. Follow and leave us a 5-star review if you're on Spotify. And please share this with your friends. We'll see you next week.